Hello, welcome to BQ Prime. You're watching a special show on the new issue which is coming in the market from National Highway Infra Trust. That's an NCD issue of nearly 1,500 crores. And joining me today is Mr. Suresh Goyal, who is the MD and CEO, and Mathew George, who's the CFO at National Highway Infra Trust. Gentlemen, thank you very much for joining us on BQ Prime. This is a debt issue, and there it needs a little bit of explaining as well to the investors who are going to come in. So take us through the contours of this NCD.
Thank you, and I really appreciate you giving us time to communicate with your viewers. This issue is a very important issue in the overall national monetization pipeline that the government has announced last year. As you're aware that the national monetization pipeline has been set up for the government to raise resources for them to reinvest into the development of Indian infrastructure, which is critical for us for the ambition that we have set out for ourselves of achieving 5 trillion of the economy. Now, within that national monetization pipeline, national highways have got the largest share at 26%. So the National Highways INvIT, or NHAI INvIT as it's called, has been set up as a mode to facilitate monetization of national highways. We launched it last year, and we were very successful in raising 8,000 plus crores. Now we are on to round two. And what has been decided is that to facilitate acquisition of more assets, that we can go into more detail, but just to coming back to your question, in order to facilitate fundraising to fund the acquisition of the 3 new roads that are going to be acquired now, we have decided to issue long-dated, non-convertible debentures into the market. We will be talking more about it in terms of what the yields are and why it makes sense for the investors to participate. But like you said, these are 1,500 crores long-dated debentures, which are being used to fund the acquisition of roads that are going to be transferred from NHAI into the INvIT.
To get it right, sir, in the first phase, you got all the big institutional investors to come and subscribe to your units. Ontario, and Canadian investment firms are there, which hold nearly 50% of the units. NHAI holds 16% of the units in there. But in the second round, you're coming through a debt issuance, which is an NCD. Why haven't you looked at opening up the units to the public in general, and why are you using a debt route?
Yeah, that's a very good question, and we debate that question quite a few times internally. So just to go back in the history of how this came into being, is that when we launched the INvIT, we were expecting that the markets would be flush with capital, and particularly the institutional investors were looking to bring money into the infrastructure sector. So the road sector being one of the sectors which institutional sector investors understand quite well, we saw a very large demand from them. And it was decided that we would be going the institutional placement route, which is what is called as the private listed route within the SEBI INvIT regulations. So we were able to get very high quality marquee investors into our INvIT. 50% of is with 2 foreign pension funds, the CPP and OTPP. And the balance 50%, including NHAI's 15%, has been placed with Indian domestic institutional investors. Most of them have not really invested into INvITs or infrastructure, but given the opportunity of long-dated road concessions which have an inflation pass-through in the tariff, they came on board. And these are primarily in 3 categories: pension funds, provident funds. Second one being insurance companies and mutual funds, and the fourth one being HNIs and family offices, right? So that's the kind of capital that we got through. When we went for round 2, which is what we are going through at this point in time, I think the only point I would like to make here is that we are not going entirely with the debt issuance, as you would have seen in the media today. So we are going with a combination of debt and units. So we already completed the unit issuance, and in fact, the units got listed today. We have been able to raise 1,430 crores from the market through a follow-on institutional placement method. We were again able to get support from existing investors, as well as very pleasingly from new investors who have come into our fold. For the balance 1,500 crores of funding the total acquisition, we are now issuing bonds. From a bondholder's perspective, which is coming in now, so they can get comfort that the unit holders have already committed into this second round, and the bondholders are coming on the back of the unit holder money already into the bank account and the units being listed.
You know, it's a very marquee issue, one of the largest road and highway player in the country. You are going to the public in general now. Is there a plan to open it up to public in the future as you embark upon getting more assets from NHAI as part of the monetization plan, or is it always going to remain institutional based, private, as we say under SEBI parlance?
So there is no hard and fast rule that we have laid for ourselves with regard to that's going to be only institutional and no public, etc. We have, as you would have seen in our prospectus and other materials out there, we have a very diversified, professional, and very competent board, which comprises of 9 individuals currently. And they bring in a ton of experience when it comes to the decision making. And in consultation with them, as well as our sponsor, NHAI, we continue to explore what are the best options for us to do the fundraising. So for example, in the current round, we could have very well gone to the banks who were very keen to give us 1,500 crores of capital at this point in time to fund the acquisition. But the board and the sponsor, we came to a conclusion that maybe we should try out, the long-dated non-convertible debentures. That's why we are here in front of the investors for that. Eventually, given that, like I mentioned, 26% of the share of national monetization pipeline is with roads, and there are going to be more roads that are going to get added into the InvIT, the board and the sponsor would be considering options, including public listing, at a suitable point in time. So we are not ruling it out.
So, correct me if I'm wrong, this will be the pipeline to monetize all road assets, or will there be any other InvITs from NHAI which may come in the future?
As of now, there is no plan from NHAI to launch another InvIT, right? Having set the platform, and I don't want to bore you and your viewers with the details of what has gone behind to set this up in a form and manner.
No, I mean, my question is basically, from the investor's point of view, if you want to get an exposure to the Indian roads and highways, this will be the platform to do it, or tomorrow you will find another InvIT coming in. That's what I wanted to ask.
There are no plans as of now for NHAI to launch any other InvIT.
Okay. Mr. George, let's come to the yield part of it. I think coupon of 7.9%. There are 3 bonds for, if I'm not wrong, 13, 18, and 25 years. How do you look at that yield, and how do you look at the yield for these particular bonds?
Yeah, so just to take a step back, actually, it is one. See, let's see how it's going to be issued. Now, it's going to be issued as one bond of face value 1,000, containing 3 strips, separately tradable principal parts. Okay, 3 strips meaning 3 ISN. So when a person is coming in, he has to buy the whole one instrument he has to buy, but he can trade it in 3 instruments, as 3 separate instruments. Now, the coupon we have factored for this is 7.90 semi-annual, which translates to almost 805. Now, looking at the yield which is there currently in the market, okay, the current yield is at par in the market, and it's we feel that it is a good deal at this point of time. Going forward in the future also, now see, we have 3 different strips. The first strip is 13-year maturity, which redemption starts from the 8th year onwards, 50 rupees each till 13 year. The second is 18-year maturity, from the 13th year till the 18th year, 50 rupees each. And the third one is 25-year maturity. So in the 25th year, the whole thing gets redeemed. Now, if a person buys it, let's say a retail customer buys it, he buys it, and if he wants to hold on to it, and he feels that India is a growing economy, and going forward the interest rate is just going to drop, it's better for him to buy, and maybe he can accumulate only the latter part of it if required. Or in case he has a sudden requirement for fund, he can sell it in the market. It's transferable. It's tradable and transferable. Now, there has been a lot of interest from the institutional buyers also. So keeping that in mind and keeping the requirements of, there's no such instrument in the market right now. So we thought this is the right time to give the retail market an opportunity to participate in the InvIT, where they, first of all, understand the product. And coming back to your earlier question, maybe that would pave the way for them to get into units, but that's a decision for a later day.
That's what, what is interesting is that this is a long dated security, and you are venturing into it for the first time, and hopefully it opens up the floodgates for all long dated securities, because in India, that's the dirt which is not found, basically, whether for insurance companies or mutual funds or individuals, or who are planning retirements or family offices who are looking at it. But the point is that, do you think that this is a pivot for long dated securities in our bond market? Because for so far we've been grappling with only 5 to 7 year bonds and NCDs, and now this is 25-year bond, which also many people who are looking for long-term financial planning can look at it.
Yeah, so I do feel this would pave the way. And one of the good parts of this is, while it's long-term, you can transfer the shorter terms, you can trade in the shorter terms also. So it gives you the long-term opportunity. At the same time, if later you realize that, okay, I don't want such a thing, it gives you an exit option. So it's best of both worlds, if I may say.
And if I may just add, ultimately one has to decide on the bond, right? One has to look at what are the underlying cash flows that are going to come out to support that. Ultimately, from an investor's perspective, that is the most important thing, right? Now, the advantage that infrastructure sector provides, and certainly the road sector provides, is that our concessions are 20 to 30-year concessions in our portfolio. Something that perhaps not many people realize in the road sector is that the revenue has an upward trajectory built in, because the revenue in a road, typically the national highway that we all use, is dependent upon two things. Number one, the traffic growth, right? And I'll go into the details about it later. And then number two is the tariff. Now, the tariff that we pay when we use the toll, or when we pay the toll and use the toll road, has inflation pass-through built in, as per the formula that exists in the concession agreement that have been entered into. So if you are talking about a revenue stream escalating over a 20 to 30-year period of the concession, right? So that we thought gives an interesting opportunity for investors and bondholders to take advantage of that long-term cash flow. And we designed the bond, that is why, in a form that is a 13-year, 18-year, and a 24-year. The maturities are last 5 years in each of them, which follow the overall cash flow that is coming out of the portfolio, right? So that's where the cushion that is built in the cash flow between in the debt obligation that the InvIT or the trust would need to meet is kind of mirroring the overall revenue growth. So that's why we thought that it's a good way for us to be able to offer such bonds. Not many cash flows in the businesses have this kind of long-term trajectory. That is why the design of the bonds also sometimes begins to falter when you're looking to do long-dated bonds.
Tell me one thing: what is the kind of blended traffic growth estimates that you have put in for your assets?
So we are not able to comment on the long-term forecast because we are not really. It's not possible for us to provide guidances on the show. But suffice to say, the facts are that our national highways and certainly the roads that we have in our portfolio are located in the major corridors of the country. They are located on GQ, Golden Quadrilateral. We are all very familiar with that word, and on north-south, east-west corridor, right? So if you just look at the country as a quadrangle, that's where the roads are located. This is the original corridor that was built way back when the National Highway Development Program started. These roads have been in operation for a very, very long time, and they carry bulk of the traffic as commercial traffic. So in our portfolio, 80% plus traffic is commercial traffic, which, I think all of us understand, generally follow the GDP growth trend of the country. So if you all believe as citizens of India and have a vision that Indian economy would reach 5 trillion and would show a certain growth path, let's say 5% or so, so that has a very strong basis for the long-term traffic forecast on these roads.
Why I'm asking this is because as part of an INvIT filing, when you were done, you would have given a 3-year projection for how your income is going to come in and how the distribution you're going to do. So that's why I asked you what is the point of projections which you have done for traffic basically.
So I think again, coming back to there is a certain expectation of GDP growth over the next few years, and it is in north of 5%. So that's a number that has gone into the prospectus also.
And because inflation has been higher, are you able to pass on the entire inflation as part of the tariff hikes on a yearly basis?
So that's actually the beauty of the toll roads, that the concession agreements, and these are standard concession agreements for all the toll roads in the country, the tariff escalation is linked to WPI of the previous year. So just to elucidate that point, the tariff every year increases at fixed of 3% and 40% of the preceding year's WPI. So I'll just give you an example. If the WPI, for example, this year is expected to be 8%, so 40% of 8%, 3.2% plus 3%, that's 6.2%. So the escalation would be 6.2% in tariff. On top of it, there will be traffic growth. So one could be in high single digits or double digits of revenue growth. What this formula does is that even if the inflation is too low, arguments say the inflation is at 2%, right, because of base effect or whatever, still you would get about 4% tariff growth because 3% is fixed.
Yeah. Okay.
So that gives us like I mentioned, again, it just gives you escalating.
So if I look at the glide path for this, around 7 to 10% annual growth in revenues coming from volume and price, if that's a best case.
You could say that. You could say that.
Okay. How are you going to use this proceeds? I understand that you're going to acquire 3 more assets from NHAI. Can you give us an idea of how big these assets are in terms of revenue terms for you?
Yeah. So these 3 assets, like I mentioned, are located in major corridors. So these assets are Agra bypass, which is the bypass around the city of Agra, feeds the traffic going into Madhya Pradesh and traffic going into Uttar Pradesh. That's one road. The second one is in the state of Maharashtra, Borkhedi-Wadner, which is on the corridor between Nagpur and Hyderabad. So again, a major corridor, part of the north-south corridor there. And the third one is Borkhedi-Wadner, Agra bypass, and Shivpuri-Jhansi, which is east-west corridor coming in from Kota going to Calcutta, right? Okay. So these are the 3 roads. The total aggregate length, there are 4 lanes. So the aggregate length is 247 kilometers, and the revenue is 300 crore plus.
Okay. Mr. George, can you give us an idea of how the payments and waterfall would be? Means the first right will be to the bondholders and then to the unit holders?
Yes, that's right, Sajid. So how it works is, see, we currently have existing loans for the first 5 set of assets, and the senior lender there is State Bank of India. So there are other 2 banks, is Bank of Maharashtra and Axis Bank, and we have the NCD holders. So now between all the lenders, there'll be pari passu sharing of charge, but that's on the charge part. Now what happens is, this money which we raise at the trust level would be given as a loan into the SPV. Okay, the SPV which right now contains all the 8 assets, all the 8 projects, let me say. These projects together forms the cash flows of the SPV, and the SPV will be making routine principal, interest, and dividend payouts to the trust. Now, at the trust level, what happens is there's an escrow mechanism whereby first the cash flows would be used to repay the payments to the lenders, Lenders means all the lenders, NCD and the bank lenders. And after that, based on the surplus will be paid to the unit holders. Now, SEBI regulations has factored in that 90% of the cash flows should at least be paid out to unit holders. So that factors after payment of the lender's money, the remaining at least 90% we should pay it out to the unit holders.
The surplus has to go to the 90 to the lenders after.
Yeah, that's right. That's right.
Okay, sir. There's a lot of debate about BOT projects today. I just want to get, because you are part of the industry, I just want to get your thoughts on it, especially with respect to the financing which is being talked about for BOT projects. What is your thoughts on that issue?
So BOT projects historically have been, a very, very important means of highway development for the country. But like everything else, life goes in cycles. The modes that are used for development of highways also goes in cycles. At this point in time, the cycle on the BOT projects is perhaps at its lower end. Generally, what the market is tending towards, and certainly where NHAI is looking at how to expand the development of the highway program, is that they are giving out more of the projects on EPC and on HAM basis, because it just allows them to expedite the development without transferring the traffic risk onto the contractors. Right? And those projects, when getting completed, and on top of it, NHAI's cost of capital is lower than when a developer uses his capital or her capital to build that project. So the cycle that NHAI is following currently is to develop projects through EPC and HAM, and then once they become operational and their traffic has stabilized, to either transfer them to InvIT for monetization or put into the TOT for that's a second mode of monetization that they're going through. So eventually, the country achieves the same target of getting highways constructed. It's just how we reach there has changed a little bit. I'm sure BOT program will come back. They've already started to issue some tenders on that. But the good old days when most of the highways were being developed through BOT, perhaps we'll have to wait for the cycle to turn.
And what will it take for the cycle to turn? What are the factors which are at play here?
So, see, ultimately, in a classic project development, project finance theory, it is about allocating the risk to the person or the entity which can handle that risk the best, right? Now, in the development of projects, what we have seen is the highest amount of risk comes in the form of land acquisition, shifting of utilities, local approvals to be taken, etc., etc. So I think right now those risks are best handled by the authority, National Highway Authority of India. Once we have more stable structure and these issues get sorted at the local level, I think BOT program will make a comeback.
And what about financing part of it? Because a lot of talk about financing and the cost of financing and debt financing for BOT is getting there is some kind of block which is there, which is preventing existing BOT players to also complete the projects. What is your thoughts on that?
See, the fact is that capital, by very nature, looks for better returns at the least risk, right? And if we are able to bring projects and opportunities for that capital to come in, both on the debt and the equity side, right? Case in point being these bonds. When that opportunity is available for them to invest into assets which do not have any development risk, construction risk, land acquisition risk, etc., and are able to invest into assets, both as NCDs or units, into operating assets, where most of these risks are taken care. Clearly, there is more capital that is getting available there. So to an extent, it's not that the capital would not be available for the BOT projects, but then it comes down to, where more capital is wanting to go, because the risks are lesser in operating assets.
Sajid, if I may just add there, see, one thing you should keep in mind is lenders per se, the lenders community, they were over a period of time realizing that they are not okay with taking the land acquisition risk. The construction risk and on the contractor completing, they were okay with. So like what Mr. Suresh said, once the land acquisition risk is taken off, That is, once the NHAI and all the local authorities get this land acquisition in thing, then lenders would be ready to get into BOTs, because then it's just a construction risk which they would be ready to take.
So how do you handle all the stuck BOT projects? Where do you, is there a solution for them? Because that's something which we all are stuck with, right?
No, not really. I think, bad news always makes headlines, but when you go into the details of, when you go into the details of the efforts that have been made for resolving some of those issues, I think it's been a tremendous achievement that's happened there. I'll just give you two examples. Number one is that normally, stuck projects get into litigation and all sorts of issues. So in order to keep them out of that messy litigation, NHAI has set up something called a conciliation path for resolving these issues. And a very high-powered conciliation committee has been formed, which has been working through this. While I don't have the numbers at the top of my head at this point in time, but it's in the public domain, that conciliation committee has actually been able to resolve a few tens of thousand crore worth of assets which was stuck, right, into either resolving to facilitate development of that asset coming back on the rails, or resolving it in a form and manner that it kind of moves to another party, which is able to take on what we call as a harmonious substitution method, right? So that is one example where we have seen a fair bit of activity. Number two is within the harmonious substitution, what has also happened is that the banks have become very, very active now, right? Earlier, the banks, because of lack of tools or for whatever reasons, were not very, very proactive in implementing their rights to be able to get the project going. So now what we are beginning to see is that the banks have become very, very proactive, and they're able to step in. They have the step-in rights under the lending documents that they enter into. So then we are beginning to see that they are beginning to use this harmonious substitution more and more. I would think that if you were to pick a newspaper now, in the last, say, 1 year or thereabouts, there will be hardly any cases that you would find with regard to litigation or issues or talking about stuck projects. So I think that's an issue that we have reasonably successfully been able to handle between the authority, developers, and the banks.
Gentlemen, it's a pleasure talking to you today, and good luck with your NCD issue, which is very attractive at 7.9% and annualized yield of 8.05%. In National Highway Infra Trust NCD is opening shortly, and it's nearly 1,500 crores. There's a 3 tranche bonds, which is STRPP A, B, and C, which is for various tenures of 13, 50, 18, and 25 years, and it has an semi-annual rate of coupon rate of 7.9%. Thank you very much for joining on.
Thank you. Thank you for giving us the opportunity. We really enjoyed speaking with you. That's Sajid. Thank you so much.
Thank you.